Welcome back to Iron Financial. This is the only explainer where we help you forge a significantly stronger portfolio. And we do it by cutting straight through all the market weakness out there. I'm your lead analyst. I'm here to bring you the hard numbers, the structural integrity, and honestly, to do the heavy lifting behind the market's absolute biggest movers.
And hey everyone, I'm the market skeptic. Look, you're pouring the concrete, and I'm bringing the hammer. Let's see what breaks today. My entire job on this explainer is to represent you, the investor. I'm going to be banging that hammer against these balance sheets to find out if this asset is actually forged from iron or if it's just paper-thin hype that's going to collapse under pressure.
Exactly. And today, we are strapping on our hard hats and taking a sledgehammer to Dole PLC's first quarter 2026 earnings framework. We're stress testing their entire overarching structure. We need to know, is their Q1 performance a solid, load-bearing foundation for the rest of the year? Or is this thing already cracking under massive macroeconomic pressure? All right, let's dive right into this. Okay, look, I gotta start with this because this is the exact contradiction that is driving me absolutely crazy this quarter. You look at an agricultural giant like Dole. How do they boast these massive, record-breaking top-line growth numbers across all of their segments, while bottom-line earnings are just actively bleeding out? Seriously, in a normal, healthy market, expanding your top floor usually means the whole building is rising, right? You generate more sales, and naturally that scales right down to your bottom line. But here, operating income literally declined. Net income fell from $38.9 million all the way down to $31.3 million. Diluted earnings per share slipped. So my question is, if the top floor of this skyscraper is expanding so rapidly, why is the basement flooding?
That is a great question, and that is exactly the structural flaw we are going to probe today. When you look at a legacy asset like Dole, a premier global leader in fresh produce, you naturally expect a reinforced steel framework capable of weathering any storm. But Q1 2026, it showed us a very mixed bag of building materials. On one hand, we have incredibly strong pricing power and highly favorable currency acting as these massive tailwinds. But on the other hand, we have significantly higher fruit sourcing costs plus prior year asset sale gains that are just weighing incredibly heavily on those operating margins. So let's pull up the blueprints and start the drill down.
Part 1. The drill down. Top-line revenue growth. All right, we are starting with top-line revenue growth because this is where I get to do the heavy lifting to lay the concrete for the bull case. Before we talk about any cracks in the armor, we really have to acknowledge the sheer, undeniable size of the foundation Dole is pouring right now. Look at the core contradiction here on the left side of your screen. You see surging top-line revenue. Dole posted a massive 11.6% increase, hitting $2.34 billion for the quarter. That is $2.34 billion with a B. That is a staggering volume of capital moving through the system, driven heavily by higher pricing and those favorable currency tailwinds we mentioned, especially over in their diversified fresh produce segments. Market skeptic. Okay, sure, the top line is huge, but look at the right side of the screen. Adjusted EBITDA, which, let's be honest, is the actual operational cash flow we actually care about. It's the money left over after the essential bills are paid. That slipped by 4.3%, down to $100.3 million. So let me get this straight. You are moving more product, you are literally charging higher prices, and yet your margins are getting structurally compressed? The higher fruit sourcing costs are just eating directly into the foundation. And we need to be clear about what sourcing costs actually means in the real world. We're talking about global inflation, persistent supply chain bottlenecks, and the rising cost of fertilizer and manual labor just to physically get the fruit out of the dirt. It's exactly like buying premium steel at peak market prices. Sure, the building's going up, but your construction budget is completely blown. Let's break that down segment by segment to see exactly where the volume is acting as a load-bearing pillar and where those margins are actively failing under the weight. First up, fresh fruit. Revenue rose 6.8% to $937.7 million, but its adjusted EBITDA actually fell to $52.6 million. That's a classic margin squeeze happening in real time. Then look at diversified fresh produce in MEA, that's Europe, Middle East, and Africa. Revenue grew to over $1 billion, specifically $1,022.3 million, but the adjusted EBITDA there, just $30.0 million. Finally, the Americas and Rest of World segment saw revenue increase to $420.0 million with an adjusted EBITDA of $17.8 million. Ouch! Wow, that is a massive drop in efficiency when you look at the raw cash flow generated versus the massive revenue booked. So the absolutely crucial point here is that the revenue growth is completely broad-based. Every single pillar of this company is taking on more weight. They are generating more cash at the register across the board. But those sourcing costs we just talked about, that's a universal stressor. They are paying significantly more across the entire globe just to get the fruit onto the boats, and it is actively shaving the structural integrity off of every single business unit they operate. Market Skeptic Part 2. The drill down, margin cracks, and ESG costs. And that perfectly transitions us right into the cost side of the ledger. We really need to interrogate this management team's capital allocation. Because, look, when margins are this tight, every single dollar spent needs to be a crucial brick in the wall, not just some decorative facade. I hear this quote from CEO Rory Byrne in their 2023 sustainability report. He stated, and I quote, "We believe that caring for our most important resources, our people, the nature around us, and the food we deliver to the world will set us up for continued success." Now, I have to ask the tough question. Is this essential architecture, or is this just really expensive corporate hype? Because when earnings per share drop and net income is sliding backwards, investors want to know if management is pouring concrete or just burning cash on glossy sustainability brochures. We need to see if these ESG initiatives actually reinforce the underlying business model. And this right here brilliantly highlights my core concern. The routine capital expenditure pipeline is guided at approximately $100 million for the year. Look, I get it. I know agriculture requires massive capital. You need to buy heavy machinery, you need to maintain massive processing facilities, you got to keep those huge refrigeration units running 24/7. But $100 million is heavy, heavy spending. I'm aggressively challenging this allocation because, as we saw earlier, diluted earnings per share have slipped from 41 cents down to 33 cents. Operating income declined from almost $68 million down to $62 million. You have to ask yourself, is a $100 million capex budget really responsible when the bottom line earnings are already showing clear signs of structural fatigue? I will counter that directly by saying you simply cannot build a 21st century agricultural empire on a 20th century foundation. This CapEx and these ESG initiatives, they represent highly tangible operational shifts that forge a durable long-term supply chain. For example, they are undertaking a 7-cent per standard box social premium from their banana production, and they are reinvesting that directly into local communities. Now, why does that matter to the actual bottom line? Because investing in your labor force and local infrastructure prevents labor strikes. It avoids nasty community disputes. It stops supply chain disruptions long before they ever happen. That acts as absolute structural framing. Also, they've achieved a 17% decrease in Scope 1, 2, and 3 emissions compared to their 2020 baseline. For those unaware, that means reducing direct emissions from their own facilities, the indirect emissions from their purchased energy, and all the upstream and downstream emissions in their entire value chain. That isn't just window dressing for a brochure, that is literally future-proofing the supply chain against impending regulatory fines and massive carbon taxes. You absolutely have to spend capital to reinforce that framing. Just look at how this builds out practically in the fields. You are seeing regenerative farming right here. They are using banana leaves to function actively as regenerative ground cover. By doing this, they are building a massive physical moat against future climate disruptions. Things like crop disease, invasive pests, and extreme weather events are literally the single biggest risks to an agricultural portfolio. By implementing a defined set of regenerative practices and eliminating over 500 metric tons of CO2 equivalent through upcycling food and material waste at their subsidiary Oppie, Dole is actively lowering their long-term operational risks. They are locking in the durability of the soil itself, so it can continue to yield product for decades to come. Okay, I hear your defense of the moat, and honestly, I respect the long-term vision. But let's talk about the cold, hard cash that is currently leaking into that moat. In Q1 2026, free cash flow from continuing operations was an outflow of $40.2 million. They are literally burning cash just to keep the lights on and the tractors running right now.
I have to admit the cash bleed, yes, but you are completely ignoring the massive structural improvement year over year. Let's look at the context. Last year, that exact same Q1 outflow was a staggering $131.6 million. A $40.2 million outflow is entirely seasonal. It is driven by the strict biological reality of the agricultural cycle. If you're new to understanding the agricultural cycle, understand this basic fact. You have to sink massive amounts of cash into the dirt up front, buying seeds, fertilizer, and paying for labor, long before you ever harvest a single piece of fruit and sell it at market. The dramatic year-over-year improvement was directly due to lower seasonal working capital outflows and strategically lower capital expenditures in the current year. They are successfully plugging the leaks in the basement, and the numbers prove it.
Part 3. Forging the balance sheet. We've looked really closely at the cash flows. Now we need to assess the structural integrity of Dole's overarching debt and liquidity profile. We need to see if they can actually weather a broader macroeconomic storm. And the truth is, management is actively shoring up the foundation. First, as we just mentioned, they've engineered those lower seasonal working capital outflows and strategically reduced capital expenditures. But the really massive structural reinforcement coming down the pipeline is the expected $75 million in net cash proceeds from the sale of their Ecuadorian port business. They've just received full regulatory approval to sell 100% of those membership interests to Terminal Investment Limited Holding SA, with completion expected before the end of the second quarter. That is $75 million of pure, unadulterated liquidity being injected directly into this concrete foundation. And frankly, they desperately need that liquidity because the debt load is substantial. Total debt, net of debt discounts, sits at $923.5 million. Now, they do have $273.2 million in cash and equivalents on hand, so this brings Q1 2026 net debt to $657.1 million. Now, if you measure that against their 2026 target adjusted EBITDA of at least $400 million, that visualizes a net leverage ratio of just 1.7x.
Wait a second, 1.7x leverage? In a notoriously high interest rate environment, carrying over $900 million in gross debt, which by the way includes $592 million in term loans and $175 million drawn directly on the corporate revolver, that is incredibly heavy lifting. That is a ton of weight pressing down on the scaffolding.
It's heavy, yes, absolutely. But the structural framing is completely manageable and it is well within their banking limits. A 1.7x net leverage ratio for a quote-unquote hard asset agricultural business is actually quite conservative. Remember, because Dole owns tangible physical assets, we're talking prime land, massive shipping vessels, huge packing facilities. Banks are far more forgiving than they would be for, say, a software company whose only assets are code and cloud servers. The hard assets act as physical collateral. They are simply not overextended. And further proving that the balance sheet is being actively stress-tested and optimized, just look at their interest expense guidance. They actually reduced their full-year interest expense guidance by $2 million, bringing it down to approximately $58 million. The baseline from their prior outlooks was roughly $60 million, but the newly updated figure is $58 million. They are aggressively managing their financing costs to ensure the floating debt doesn't crack the foundation.
You know what? I'll give them full credit there. Shaving $2 million off your financing costs in a stubbornly high interest rate macro environment, that is a really smart, highly tactical way to protect the basement from flooding. Every single dollar saved on interest payments to the bank is a dollar that can be reinvested right back into those hard assets.
Market Skeptic, Part 4. The verdict. Opportunity or trap? All right, we've inspected the blueprints, we've walked the site, and we've stress-tested the steel. It's time to bring both of our personas together, weigh these heavy metrics, and deliver a definitive, absolutely no-nonsense conclusion on this asset's durability. Let's start with the immediate yield being offered to investors right now. Dole declared a quarterly cash dividend of $0.085 per share. If you look at the dividend coverage, it sits very comfortably at approximately 2.0, offering an optimized yield of around 2.4%. And they have massive headroom built into the framework. Their debt agreements currently allow for up to $672.9 million in dividend payments before any hard limitations kick in.
Yeah, but the real question is an 8.5-cent dividend and a 2.4% yield really enough structural reinforcement to keep investors holding the stock during broader market weakness? It's a nice, steady payout, sure, but if those global fruit sourcing costs keep compressing the EBITDA quarter after quarter, that 2.4% yield is absolutely not going to protect you from a falling share price. It could very well be a yield trap cleverly disguised as a solid floor.
But the dividend isn't their only tool for rewarding shareholders and maintaining structural integrity. They have an ongoing $100 million share repurchase program. During the first quarter, they actively bought back 306,570 shares for $4.6 million. And they still have approximately $95.5 million fully available for future repurchases. Look, when a company buys back its own stock, it reduces the outstanding float, which naturally and artificially boosts earnings per share. It is the ultimate sign that management genuinely believes their own foundation is rock solid. They clearly think the broader market is undervaluing their underlying hard assets, so they are stepping in to buy the dip with their own cash.
Market skeptic. They are buying the dip, I'll definitely admit that, but they still have $95.5 million locked and loaded in the chamber. Let's see how aggressive they actually get with deploying that capital if the share price starts to genuinely waver under margin pressure. Talk is cheap, right? Executing the buyback when things get tough is what actually matters.
Summarizing the final risk-reward ratio, look at the milestone they just hit. They posted $100.3 million in Q1 adjusted EBITDA. Their full-year 2026 target is at least $400 million. They have successfully achieved exactly 25% of their annual target in exactly one quarter. They are perfectly on pace with the blueprints.
I'll concede they hit the Q1 milestone right on the nose, absolutely. But Q1 had highly favorable currency tailwinds completely propping it up. can they maintain that aggressive pricing power across their fresh fruit and EMEA segments to offset the rising sourcing costs for the remaining 75% of the year? If pricing power slips even a fraction, that $400 million target becomes a very heavy, potentially crushing load to bear.
So, what you should ultimately take away from this explainer is a clear, unobstructed picture of a massive company in transition. The top-line revenue is growing aggressively, the debt is completely manageable at a conservative 1.7x leverage for a hard asset business, and the impending $75 million port sale provides a massive liquidity cushion. The foundation looks solid, reinforced, and completely ready to scale to me.
But the operating margins are actively cracking under the intense pressure of global sourcing costs, and the bottom line net income is down. The basement is still taking on water. We want to challenge you, the viewer, to look at this data and decide for yourself. Is Dole an ironclad buy forged for the long term, or is it a structural yield trap built on paper-thin hype?
That is exactly the critical question you need to answer before you deploy a single dollar of your capital. Thanks for joining us for this deep dive into the numbers. Keep your portfolio strong, keep cutting straight through the weakness, and we will see you on the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.